Welcome to this explainer on Grupo Aeroportuario Del Pacifico's Q2 2026 financial results. We're going to unpack one of the most fascinating corporate mysteries of the entire quarter today. If you follow the aviation sector, you already know that passenger volume is usually the absolute, undisputed king of metrics. But this quarter, Gap completely flipped that script.
So here is the central question we really need to answer today. How in the world does a major airport operator see nearly 890,000 fewer passengers walk through its doors, yet somehow walk away with an increase in overall profits? On the surface, it literally defies the basic physics of the aviation business.
Just look at the immediate contradiction here. We are looking at a 5.6% drop in total passenger traffic. That's a loss of nearly 891.6 thousand total passengers across their 14 airports, compared to the second quarter of last year. Yet, juxtaposed right next to that massive drop, we see an 8.4% increase in EBITDA.
And that 8.4% bump, it pushed their EBITDA, which is essentially their core operational earnings, to a staggering 5,965.3 million pesos for the quarter. Their EBITDA margin actually expanded from 67.1% up to 69.3%. This wasn't some weird accounting error or a fluke. It's clearly the result of a highly specific strategy that somehow completely insulated them from a severe operational downturn. But, first, to truly appreciate how they pulled this off, we really need to see exactly where all those passengers went.
Section 1. Passenger Traffic Headwinds, a turbulent quarter for aeronautical volume.
When we break down the terminal passenger data across their major hubs, the bleeding is pretty obvious. While Guadalajara showed some resilience, they had a nice little 3.1% bump in domestic traffic. The rest of the board was pretty much painted red. Major tourist and transit hubs like Puerto Vallarta and Tijuana experienced significant drops, 6.2 and 7.7% respectively in domestic flyers. But wow, look at Montego Bay. International traffic there absolutely plummeted by 21.6%. Overall, aeronautical revenues were dragged down by 3.2% across the board.
But to be fair, the villains of the quarter weren't necessarily operational failures by Gap. They were facing massive macroeconomic headwinds. First off, you had a 10.9% appreciation of the Mexican peso against the US dollar. For an airport operator, a super strong local currency severely impacts the revenues you generate from international passenger charges when you translate them back. Second, Mother Nature took a huge toll. Hurricane Melissa just devastated Jamaican airport traffic, causing a brutal 16.9% decrease in passenger volume in that region alone. So how did they survive this downturn, weather a literal hurricane, swallow a massive currency disadvantage, and still post record earnings?
That brings us to Section 2, the reveal, the CBX merger, and how Gap flipped the script on May 1, 2026.
The answer lies in a really massive strategic maneuver that took effect on May 1st. Gap executed a business combination with Cross Border Express, or as it's commonly known, CBX. Basically, they purchased the remaining 25% equity interest to take full 100% ownership of the business. To make this happen, they issued roughly 89.7 million new net shares. But here's the crucial part. They didn't just buy the asset. They internalized the technical assistance and technology transfer services, bringing the whole shebang completely in-house.
And guys, this wasn't just some minor bolt-on acquisition. This was a fundamental shift in the company's financial DNA. It injected massive assets into their balance sheet practically overnight. As the earnings report details, this merger resulted in a cash increase of over 5.4 billion pesos, and it generated an astronomical 30.8 billion pesos in goodwill. That's essentially the premium they paid for the immense value of the CBX operation. They also added over 6.8 billion in intangible assets. It's huge.
Let's look at the immediate cash flow impact, though. By instantly consolidating CBX operations for just May and June, so literally only 2 months of the quarter, Gap added 468.1 million pesos in fresh, high-margin revenue. The unit economics here are wild. Over 626,000 passengers use the CBX facility, generating an average revenue of $42.8 per passenger. That is an incredibly high monetization rate just for foot traffic, and it was now flowing directly onto Gap's consolidated income statement. And this brilliantly illustrates the broader strategy that completely insulated Gap's bottom line.
Section 3. The non-aeronautical boom. Diversification saves the day.
When we break down the total Q2 revenue, which hit nearly 11.3 billion pesos, the shift is just undeniable. Aeronautical revenue is still the biggest slice, sitting at 5.57 billion. But take a close look at that non-aeronautical slice. It has absolutely ballooned to over 3 billion pesos.
The divergence here is easily the most important takeaway of the entire quarter. Aeronautical revenues, the money made from actual planes and flight charges, decreased by 3.2%. But non-aeronautical revenues absolutely skyrocketed, jumping up by 23.9%. Basically, while flight traffic dipped, Gap's ability to monetize the passengers who actually did show up and all the infrastructure surrounding them, that went into overdrive.
And this growth is highly strategic. It's not just that they're collecting more rent from third parties. Actually, revenues from third-party operators slightly decreased. The massive growth came from businesses Gap operates directly. By cutting out the middleman, they captured way higher margins. Cargo operations jumped 22%, convenience stores grew 11.3%, car parking grew 9.1%, and hotel operations up 26.7%. They aren't just running an airport, they're actively controlling an entire commerce ecosystem.
And honestly, thank goodness they had this domestic operational strength because their Caribbean footprint took a massive hit. Operations in Jamaican airports faced such heavy headwinds from Hurricane Melissa and that currency translation issue we mentioned earlier that non-aeronautical revenue there plummeted by a staggering 54.4%. If Gap hadn't engineered that massive 59.4% surge in their directly operated Mexican businesses, which was largely fueled by the CBX integration in cargo, this earnings report would have been an absolute disaster.
Section 4. The strategic takeaway. Insulating from operational vulnerabilities.
So at the end of the day, here is the bottom line. Despite losing nearly 1 million flyers, despite a tough double-digit currency headwind, and despite a devastating hurricane in a key market, Gap somehow managed to increase their net income by a solid 9.0%, reaching 2,893.5 million pesos.
This Q2 report serves as an absolute masterclass in revenue diversification. By expanding their income streams into direct retail, cargo, hotel operations, and completely internalizing massive assets like the Cross-Border Express, Gap proved a major point. Controlling the entire customer ecosystem is far more profitable and way more resilient than just sitting back and counting airplanes taking off and landing.
Which leaves us with one incredibly compelling thought to take away from all this. As extreme weather events become more frequent and as macro currency fluctuations just become the new norm, single revenue stream airport operators are going to look increasingly vulnerable. If controlling the surrounding infrastructure is literally the only way to shield from falling traffic, will we see a massive wave of aggressive mergers and acquisitions across the rest of the global aviation sector? It is definitely something we're going to be watching closely as we move into the second half of the year. Thanks so much for joining me on this explainer, and I'll catch you next time.